Hello everyone and welcome. My name is Elliot Yu. I'm co-founder and publisher of Capitalist Times, and welcome to our YouTube channel. Those of you who may have subscribed to the Capitalist Times YouTube channel in the past, or some of the publications that I write or my colleague Roger Conrad writes, probably know that we haven't been really active on this YouTube channel in a while. We haven't posted that many videos. We've been pretty infrequent about it, and we really want to change that. I'd like to produce more of these short videos covering topics of interest to you as investors, trends we're looking at, even occasionally some stocks. And most important in all, I'd like to answer your questions and cover topics that you're interested in. So if you'd like to see more videos like this, it's absolutely free to subscribe to our YouTube channel. You click the subscribe link that's under this video. Also, if you click that little bell on your screen, that will actually alert you in your email every single time we post a new video to this YouTube channel, so you can stay on top of the latest. Also, would really enjoy it if you would post any comments you have about this video or any questions you might have investment related that you'd like me to cover in a future video. But with that, today I want to talk about the oil market, the energy markets, which of course is a sector I've covered for many years. And in particular, I want to talk about the weekly crude oil inventory reports that come out of the Energy Information Administration every Wednesday at 10:30, showing how much oil is in storage in the U.S. and a whole host of additional statistics. And I've received a number of questions from readers and of subscribers to this channel in the past about the last few weeks of inventory data that we've seen out of EIA. In particular, a couple of weeks ago, we saw a 10 million barrel build in crude oil inventories, which is a very large build for this time of year. In fact, oil inventory should kind of be flat or falling at this time of year. And this week, just today in fact, as I'm recording this video, the EIA released a report showing a 5.4 million barrel build in U.S. oil inventories in the last week, compared to expectations yesterday for actually a decline in crude oil inventories. So what's going on? What does this mean? And in particular, a question I've gotten a lot is, why aren't oil prices falling more meaningfully? They've come a little off their highs in late April, but not much. Why aren't they falling more meaningful in response to these much larger than normal seasonal builds in U.S. oil inventories? So I'm going to show you a few charts here and kind of explain what I think is going on and why it's actually rather bullish for oil in my view this summer. This first chart I'm going to throw up on your screen is actually a seasonal chart of U.S. oil inventories. And by seasonal chart, there are four lines on this chart. The orange line there, which is labeled 2019, is the path of U.S. oil inventories so far this year. That's the amount of oil in storage here in the U.S. So far this year. That thick green line is the 5-year high in inventories for every week of the year. The blue line, the lower blue line, is a 5-year low in inventories over the last 5 years. And that dotted yellow line in the middle is a 5-year average of inventories. So a couple of things to point out on this chart. First of all, I want you to look at that yellow line on the chart. And I want you to look at the seasonal trends in inventories in the United States. And I'll explain why this happens. But you can see early in the year, from the beginning of the year, the far left-hand side of the chart, through roughly late April, usually early May, U.S. oil inventories rise. Okay? Why is that? Well, there are a couple of things. First of all, demand for oil in the spring months is relatively low. That's because heating oil demand begins to slacken up a little bit as the weather warms up. Believe it or not, still a lot of parts of the United States, people do use heating oil, particularly the northeastern U.S. But demand for that sort of slackens as we get into the spring months because it's not that cold out anymore. And we haven't yet gotten to the peak of gasoline demand, which comes in summer driving season. So what you have at that time of year, demand for oil is relatively low. Demand for gasoline and diesel is relatively low. Sometimes you'll hear it referred to as shoulder season. And so, therefore, we're not using as much oil as normal. Inventories of oil build up. It's also a function of the fact that, of course, refiners want to store more oil to have on hand. So when it comes time to produce gasoline for summer driving season, which is the peak of oil demand every year, they have it on hand to actually produce the gasoline and diesel that we all need. Then you'll see from late April, early May, all the way up until late September or so, U.S. oil inventories fall. That's because demand is very high in the summer. Therefore, we're using more oil than we're producing and importing, so inventories generally fall. Then we see another tick up in oil inventories from October through November roughly. That's again another shoulder season. We haven't yet gotten into winter heating season. However, summer driving season is over by that time. Therefore, oil demand is lower, oil inventories build, and then we start the cycle once again. So what you really want to look for when looking at oil inventory numbers is some sort of a counter-seasonal trend. In other words, are oil inventories falling at a time of year where they're normally rising, or vice versa? Are they rising at a time of year when they're normally falling, or not falling as fast in a time of year when they typically fall rather quickly? And obviously when that orange line, in this case 2019, is above the yellow line, it means that oil inventories are above average. There's a lot of oil supply out there. When that line is below that yellow line, it's telling you that oil inventories are below the 5-year average, and that would generally be bullish. So what do we see here? This year, U.S. oil inventories started out above the 5-year average. Then sometime in March, they fell below the 5-year average. You can see that dip below. But since the end of March, we've seen a surge in U.S. oil inventories to well above the 5-year average. And it's actually, they continue to build. We're now halfway through May at a time of year when U.S. oil inventories would normally be falling. Now that would normally be a very bearish development. What that would suggest that obviously that one of two things is happening. Either there's too much supply, maybe U.S. oil companies are producing too much oil, or we're importing too much oil, there's too much supply out there, or there's a problem on the demand side, right? Oil demand is weak, therefore oil is building up in storage, but it's bearish, right? Well, let me flip through a couple more charts and show you the story behind that headline that you've probably seen. This next chart is also part of the weekly inventory report released by the EIA, and it's actually refinery utilization here in the U.S., okay? So what this tells us is how much of U.S. refining capacity is actually being used. Now remember, you and I don't actually use oil, okay? We use gasoline and diesel fuel in our cars. They're used in long-haul freight trucks, railroads, etc. Are refined products like gasoline, diesel fuel, jet fuel, etc., kerosene. We don't use oil directly. The companies that actually use oil are the refiners, and refiners are basically manufacturing companies. Their key raw material is crude oil, and their key products are gasoline and mainly diesel fuel, or what we call distillates. So what you see here is what percentage of total U.S. refining capacity is actually turning oil into these refined products. So for example, if this is 100%, it means that U.S. refiners are running flat out, putting as much oil through their facilities as possible. Oil demand is very high in that case. When it's, say, at 75%, which is very low, very unusual, that means that about 25% of U.S. refining capacity is sitting idle. Sometimes you might see that, for example, during a hurricane that takes out a lot of capacity on the U.S. Gulf Coast, but very unusual to see that. Again, this is a seasonal chart, and let's look at that yellow line again to see what's going on. Typically, U.S. refinery utilization falls early in the year up through the spring months. As I explained earlier, that's because demand for refined products is relatively low that time of year. It also gives refiners a chance to perform maintenance on their operations. And that totally should make sense, right? Why would you try to perform maintenance on your facilities when they're running full out and demand is really high for your products? You don't want to do that. You want to do that when you don't need to use all your capacity and you can afford to take a refinery offline for a bit to perform maintenance. They also do some turnaround activity. For example, switching from a winter blend gasoline refining to a summer blend gasoline refining. So you can see U.S. refinery utilization falls from the 92-93% range usually to start the year, all the way down into the mid to upper 80% range by late February, early March. And again, this is refinery maintenance season. We then see a ramp up in activity through summer. Usually we reach peak refinery utilization in July, August, as refiners are pumping out as much gasoline as possible to meet summer driving demand. Then we see another downdraft in refinery utilization in the autumn months for that next shoulder season and for maintenance and turnaround at that time of year as well. So look at the orange line compared to the yellow line on this chart in particular. So refinery utilization this year relative to the 5-year average. And you'll notice that it is well below average. And it's been consistently below average since basically early February. We've only seen 1 week where it's been above average, above the 5-year average in terms of utilization since early February. And what that tells me is that U.S. refineries aren't as active for this time of year as they normally would be. In fact, we've seen several weeks where the orange line on their chart is below the blue line on the chart, indicating that we're setting a 5-year low in refinery utilization. Now again, that could be a bearish thing, right? If refineries aren't churning out more gasoline and diesel, why would that be? Well, it could be because there's already too much gasoline and diesel in the U.S. market, or that demand is weak, therefore there's no need for them to produce more gasoline and diesel. But as I'm going to show you in the next couple charts, that's not the case this year. This is a seasonal chart of 5-year motor gasoline inventories, gasoline inventories. What we've seen is the gasoline inventories started 2019 way above average levels, actually setting 5-year highs in terms of the amount of gasoline in storage. But gasoline inventories have plummeted, and over the past month or month and a half or so, they've fallen below the 5-year average at a time of year where refineries would normally be producing quite a bit of gasoline to get ready for the summer driving season. Let's flip over to distillates. This would be diesel, heating oil, products like that. Here you see we started out 2019 below the 5-year average, and we've continued to fall further below the 5-year average. So there's not too much gasoline in the U.S. In fact, there's less than normal. There's not too much distillate or diesel in the U.S. In fact, there's less than normal. So it doesn't seem to be a demand problem. Why aren't the refiners producing more gasoline and diesel fuel for this time of year? Why are around 90% of U.S. refiners' capacity actually being utilized compared to a normal range more like 92-93%? Well, it's certainly not profitability. Because gasoline and diesel inventories are rather tight, prices are relatively high compared to oil itself. Refiners don't make money from rising oil prices. They make money, they buy oil, so oil is a raw material cost, and they produce gasoline and diesel. Because stocks of gasoline and diesel inventories are lower than normal for this time of year, prices are relatively high. This is a chart of what we call the 3-2-1 crack spread. This is a theoretical profit margin for a U.S. refiner to convert 3 barrels of oil, West Texas Intermediate crude oil, into 2 barrels of gasoline and 1 barrel of diesel. And you can see here that the orange line is well above the yellow line, close to that green line. In other words, refining margins are well above average for this time of year. This is the market's way of screaming to refiners, we need more gasoline, we need more diesel fuel, and we're willing to pay you in the form of higher market profit margins. So what is going on? Why are refiners not working harder for this time of year? Well, the answer is really that this refinery maintenance season, remember I told you they usually take advantage of this period of weak demand to perform maintenance on their facilities. This refinery maintenance season is a little more active than normal. Refiners are doing more work than they normally would at this time of year. One major reason for that is something called IMO 2020. IMO stands for the International Maritime Organization. Now this is a global body which basically regulates ocean-going shipping. It's not a U.S. body. Most countries around the world are signatories to this organization, and they regulate ocean-going ships. Tankers, freight ships, container ships, you name it. The IMO has a new regulation due to go into effect on January 1st, 2020. I know 2020 may sound like a long way away, but obviously now it's only about 7 months away. And what this is going to do is it's going to say that ships, ocean-going ships, must burn a lower sulfur fuels than they have traditionally. Right now, IMO regulations say that ship fuel, bunker fuel, can only be about 3.5% sulfur by weight. On January 1st, 2020, that's going to drop from 3.5% all the way down to 0.5%. Now that gives ocean-going vessels two basic choices. One, they can install scrubbers, which take out that excess sulfur out of their emissions. What the IMO is trying to avoid is sulfur dioxide, which causes acid rain and all kinds of other nasty pollution side effects for our oceans. They're trying to prevent or lower sulfur dioxide emissions. And so you can install scrubbers on the smokestacks of your ships that'll take out some of that excess sulfur caused by burning high sulfur fuels. The problem is that most U.S. and global ocean-going vessels don't have scrubbers advanced enough to comply with IMO 2020. So that brings me to the second choice. The second choice to comply with this is to burn lower sulfur fuel. You can burn low sulfur diesel fuel, which traditionally has been used for more on-road trucking and railroads, etc. You can burn diesel fuel, or you can burn low sulfur bunker fuel. So it's going to take time for the world's fleet to upgrade to these more capable, more advanced scrubbers. It is likely to take at least 2 or 3 years after January 1st, 2020 for the majority of the global fleet. I believe the current projections are up to around 65 or 70% of the global fleet to have these scrubbers in place. In the meantime, which is a couple of years now, we're going to need more diesel fuel, low sulfur diesel, and more low sulfur bunker fuel to meet these IMO 2020 regulations. Right now, as I speak, about 58% of the U.S. bunker fuel market is high sulfur fuels. That's going to effectively go away almost entirely on January 1st. Again, 7 months away, less than 7 months away. So that's not going to be an option any longer. And as I said, that's going to increase demand in the short term for this low sulfur diesel and low sulfur bunker fuel. So where are all these ships going to get that bunker fuel? Well, refiners have different capabilities. In the United States, we have some of the most advanced refineries located anywhere in the world. And U.S. refineries are capable of taking higher sulfur residual fuels and generating more low sulfur fuel. They're capable of stripping more sulfur out of that bunker fuel, out of that diesel, to comply with IMO 2020. They're able to tune the refineries, tune their facilities to increase the yield of these low sulfur fuels that are capable of meeting IMO 2020. So refiners are fine-tuning their operations right now. They know that come the fourth quarter of this year, when they would normally also be producing maintenance, it's already going to be too late to meet this demand. These refineries want to churn out more of this low sulfur fuel in preparation for January 1st, 2020. That doesn't mean starting in November and only having a month and a half to do so. You need to be ready so that this autumn you can run more of this fuel to build up stocks ahead of this major regulatory change. So what they're doing is they're performing maintenance and upgrades on their facilities right now to be able to maximize their output of these low sulfur fuels so we don't have a shortage. Not only to meet domestic demand here in the United States for these low sulfur fuels, but also for exports to other countries around the world who need U.S. refineries to produce this low sulfur fuel to meet that regulatory environment. So in summary, the reason U.S. oil inventories are building right now to above the 5-year average has absolutely nothing to do with weak demand, nor does it really have anything to do with excess supplies, excess U.S. production at the moment, or excess imports from other countries around the world. It has to do with refineries not running their facilities as much this time of year as normal because they're performing extra maintenance and upgrade work on those facilities right now, in many cases to meet demand from this new International Maritime Organization rule due to go into effect in about 7 months from today. So What we have here is a situation where I think the headlines are misleading. If you look at these big inventory builds, you'd think that oil should be plummeting, but when you dig deeper into the numbers, you actually see a very, very, very different story. Okay, so here's the thing. U.S. gasoline inventories are very low for this time of year, and U.S. distillate inventories, diesel inventories, are still below average, and refineries are performing all this maintenance to comply with IMO 2020. The fact is, though, that you and I are going to want to drive this summer. Summer driving season is coming up. We're going to need more gasoline in the U.S. So over the next few weeks, I do expect those refineries to come back for maintenance and to have to work extra hard over the summer months just to meet demand, normal seasonal demand for oil and for gasoline this summer. And that's going to mean that I think you're going to see oil inventories come down rather sharply, more sharply than normal, as those refiners try to push back up those rather thin inventories of gasoline and diesel this summer. So I think that's going to end up being quite a bullish development for oil prices ahead. Again, I hope you found our discussion about U.S. oil inventories today useful. It's a question I've been getting a lot lately. My name is Elliot Gu. If you would like to receive more videos like this, please click the free subscribe button to subscribe to our YouTube channel here. If you click the little bell icon below this video, YouTube will also alert you every time we post a new video. We are planning, as I said, to make this YouTube channel more active and hopefully more useful to you, and to post more of these informational videos and updates. So I'd really appreciate it if you would leave me some comments on this video, good or bad. And I'd also like you to, if you ask any questions you might have, post suggestions in the comment section below. It's absolutely free, of course, for future videos, ideas for future videos. So I can make this channel and these videos, and my colleague Roger Conrad as well, can make his videos as useful as possible to you. Thanks for listening. We look forward to publishing more of these videos in the future. Thanks again. Again, my name is Elliot Gu.